Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to be talking about FICE. What does that even mean? To help me out, I'm joined by US partner Maureen Kling. Welcome to the studio.
Thank you, Ruth. Happy to be here.
Perfect. So could you just start off by what is FICE, as in just the anagram?
Sure. So what does FICE actually stand for? Well, it stands for Financial Instruments with Characteristics of Equity.
That sounds fun and not that easy.
No, it takes a while to get into it, but it's fun once you know the basics.
Marie's a big FICE fan. So could you give us a bit of an update on what is the FICE project?
Sure. So you may remember that as part of the revisions to the conceptual framework, the board actually had maintained sort of this binary distinction between liability and equity. But at that time, it also agreed to further explore the distinction between liabilities and equity as part of a separate project. Because frankly, at that time, we didn't want to hold up much needed revisions to the conceptual framework, and so went ahead and revised the conceptual framework and then decided to look at that distinction again as part of a separate project. So that's our FICE project.
Ah, so good old debt equity.
I know. And the board's also heard a lot of feedback on debt equity. So the feedback from users was that sometimes the distinction is not always clear between liability and equity. The disclosures are not always that transparent, and frankly, preparers have had a lot of challenges applying our current debt equity model. So the board has listened to all that feedback and put all that into the discussion paper on FICE.
So what's the current proposal for distinguishing between debt and equity?
Sure. So the board has put forward what it calls a preferred approach. And I call it sort of a holistic approach that really has three prongs: classification, presentation, and disclosures. So if we start with classification, it sort of looks at two tests. So your first test is the timing test. Is there an unavoidable contractual obligation to transfer economic resources at specific points in time other than liquidation? That's your timing criterion. And that's your amount criterion, is there an unavoidable contractual obligation for an amount that's independent of the entity's available economic resources? Now I see the look on your face where if you're like, what the hell is available economic resources? What on earth is available economic resources, right? Let's look at the definition of available economic resources. So it's your total recognized and unrecognized assets minus your total recognized and unrecognized claims. And the word claim here is used generically, other than the instrument you're assessing for classification.
And does the standard say what a claim is?
No, that's a great question. It's used generically, but certainly that's an area where we're having some questions. I want to cut that out.
Okay, don't do that.
No. So the second prong is presentation, and that the board is looking at certain liabilities, and for some liabilities, it's proposing that changes in those liabilities would actually go into other comprehensive income. And those liabilities would also be presented separately on the balance sheet. So that's a big change in terms of presentation. And last but not least, our favorite, disclosures. So again, the board is looking at improving disclosures in that area, priority on liquidation, terms and conditions, or just potential dilution of ordinary shares.
And will that be more disclosure requirements in IFRS 7? Or we don't know yet, I suppose.
Yeah, I don't think we know that. The intent is to have more disclosures. Where they will be located is remains to be seen.
Okay, perfect. So we've got their current proposal around classification, around presentation and disclosure. There are three
That's
bits.
Right.
How does that differ from what we've currently got under IS 32?
Yeah, great question. So let's start with classification. If you look at IS 32 today, we also have a timing criterion. It's does the entity have an unavoidable contractual obligation to transfer cash or other financial assets? So that's pretty similar to the timing criterion in the discussion paper. But the amount criterion is different. Today, there's also a second criterion in IS 32, but it looks more at, is there an obligation to deliver a variable number of shares? Or if you look at derivatives, is there an exchange for a fixed amount of cash for a fixed number of shares? So that's a little bit different from that new amount criterion where we're looking at, is the amount independent of the entity's available economic resources?
So on that timing and amount, you mentioned there the two criteria. How will that actually work?
Yeah, so let's dive a little bit deeper into the two criteria. So again, timing, I think you and I would agree, it's pretty straightforward, right? Is there an obligation to transfer economic resources, to pay cash at a specified time other than liquidation? I think the amount criterion is actually a little more challenging. So the concept there is that the obligation, the amount, is independent of the entity's available economic resources. And so that's looking more at the amount of the obligation to determine whether or not the instrument should be classified as a liability.
Okay.
So I can then maybe take a few examples, Ruth, right? It's still pretty theoretical. So let's start with the simple bond, right? The entity's issued a bond. What happens, right? The entity is then committed to pay cash for the principal and interest. So if you run that for the two criteria, timing criteria, yes, there is a contractual obligation to transfer economic resources at specified points in time other than liquidation, so the timing criterion is met. What about the amount criterion? Well, the amount is independent of the entity's available economic resources, right? There's fixed amounts of principal and interest. Those amounts don't change with the available economic resources. So in this case, it's a liability, and both criteria are met, right? The timing and the amount criterion.
What about something like a compound? That's always tricky.
Yeah, so compounds is a great question. You'll still classify the instrument into liability or equity based on the different features. So that actually stays in IAS 32. But maybe a more interesting one is preferred shares that are redeemable at fair value, for example. So is there an obligation to transfer cash or economic resources? Yes, it's redeemable, right? So the entity has an unavoidable contractual obligation to pay cash. Is the amount independent of the entity's available economic resources? So here it's a little bit different than my bond, right? Because the amount is dependent on the entity's available economic resources. It's fair value. And so here, the amount due will change with the available economic resources. So in this case, only the timing criterion is met, but the amount is not independent. So the amount criterion is not met. But still, because we meet one criterion, it will be classified as a liability.
That's what I was just going to say. So you just need to meet one.
One, correct. Okay. And in some cases you meet both. In some cases you meet the timing criterion. In the other case you meet the amount criterion.
Okay. Thank you. Those examples I think helped us understand. Like you hear the words, don't you? It sounds really complicated until you actually think through an example.
Sure.
Okay, so and what about some of the changes around, like you mentioned, high-level presentation and disclosure? Could you give us a bit more detail on those?
Sure. So presentation, again, I think I like to summarize it, not all liabilities are equal, right?
Yeah.
I've kind of described the different criteria. You could meet one or the other, or you can meet both. And so what the board is trying to do is say, well, for some liabilities, different presentations should apply. And that's, again, your liabilities where the amount is not independent of the entity's available economic resources. Or if you don't like double negatives, is dependent on the entity's economic resources.
That's better.
And for those liabilities, the changes, so items of income and expense associated with those liabilities should go through other comprehensive income with no recycling. So that is a big change compared to what we do today. And just from a balance sheet presentation, those liabilities should be presented separately as well on the face of the balance sheet. So it's really trying to sort of present those types of liabilities differently from the others.
Yeah. Okay. So that is a very different way of presenting.
Correct. So that's a big change. That's why I like to describe the project as really a holistic project, classification, but also presentation and disclosure.
Yeah.
Because sometimes classification just isn't enough, right? You have a binary distinction, liability or equity, but that doesn't tell the entire story.
Yeah. So now there's almost types of liabilities that are presented separately as well.
That's right.
Okay. Perfect. So lots, I think. One, it's getting our heads around the changes, seeing if there will be differences with IAS 32 and thinking about maybe some of the instruments clients have got. Obviously, it's early stage in the project. What should companies actually be doing now?
Yeah, that's a great question. And actually, one key change that I wanted to highlight as well in terms of the classification is just For example, an irredeemable preference shares, if you run that through the amount criterion under the board's proposal, it would actually pass the amount criterion, meaning it would be classified as a liability. And why is that? It's irredeemable, it's perpetual, but it's got a stated coupon that accumulates, so it increases over time. And that is a liability. And why is that? Because the amount is independent of the entity's available economic resources. And that's a big change compared to IAS 32 today, because those instruments today would be equity, right? Because there's no obligation to transfer cash or another financial asset. So there are some changes embedded in here that I would encourage entities to look at and certainly consider. And that's a good segue to your question is, what should companies do?
Yeah.
Study the discussion paper, look at the conclusions for some of those instruments, and respond, provide feedback to the ISB so they can decide on what the next steps are.
And the feedback you mentioned there, January.
Correct. So
Okay.
early January 2019, yes.
Perfect. And then what after that? How would people keep on top of what's going on in the project?
Just follow the ISB. The ISB publishes a lot of guidance on their website. We publish guidance as well in terms of the proposal. Our comment letter will be out, and just stay on top of any discussions and any changes in the board's approach.
And maybe, Marie, when we get anything else out from the board, you could come back and give us an update.
Exactly. So
Fly all the way back over.
In a few months, I'll be back to tell you what really happens now.
Perfect. Anything else you want to add before we leave?
The one thing we didn't talk about is derivatives on own shares.
Why not end on a high with derivatives?
I know. Sometimes people, after I've described the entire project, don't want to listen to derivatives anymore. But as you said, Ruth, I like this project, so I'm also interested in derivatives. So there's also this good discussion on derivatives on own shares. At a high level, it's the same principles that would apply to derivatives, so your timing and your amount criterion. There's a lot of guidance in the discussion paper as well for derivatives. What is independent of the entity's available economic resources? And so there's a good section that has some practical examples there as well. But
so more guidance than what we've currently
correct,
got.
yeah.
Okay.
Yeah, so don't forget about the derivatives, they're addressed as well.
I
so.
always forget about the derivatives systems. Like to keep it simple. Perfect. Well, thank you very much. That's really, really useful. And like Marie said, if you want to follow the project, obviously it's on the ISB's website, but also we'll have regular updates on on PwC Inform as well. So thank you for joining us, Marie.
Thank you very much. It was a pleasure to be here, and hopefully I'll be back with some further updates.
Yeah, exactly. More good news,
All right.
more exciting FICE project. So thank you for listening. I've been your host, Ruth Freedy. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.